Hi, and welcome to Random Rogers Big Picture for the week of March 30th, kind of quarter end. We've got one more day, and according to Bespoke, the average move on a last day of a quarter is a decline of something like 30 basis points, I believe. But I'm going to talk a little bit about the quarter and a little bit about the market with this video. I used to go ahead and talk about specific numbers. I'm going to back off from doing that and just kind of give you a sense of how the portfolio did. I'll disclose whether it was a good quarter or bad quarter, or the quarter was a push relative to the market. This past quarter was a pretty good quarter. Because of the decline, the S&P 500 as of the close Friday was down 10.4%. But then if you add back in the dividend, that's probably, I don't know, 45, somewhere between 45 and 50 basis points. So just under 10% would be the net decline. The result I had as a function of cash and the double short was, again, as the market did this, the portfolio kind of did that. That's kind of been the case throughout. And it's been enough months and quarters now that I think as that continues, if I don't make big changes at the wrong time, I suppose that is, I feel good about how that is set up in the future for this to hopefully continue, and we'll just see if it does. The market... one thing I kind of noticed is there was a whole lot of optimism at the beginning of this past week, and maybe at the end of last week too. I'm not sure, the week before. But we had really a pronounced deterioration in the last couple of days of the week, but it didn't seem to elicit any sort of emotional reaction at all, which kind of makes me think that, if the bear market process is a bunch of ups and downs and feel-good rallies and all of that stuff, the kind of the sentiment that I think I saw and some of the reaction internally in the market that I think I saw, or I guess how I'm interpreting what I saw, kind of tells me that this little, as we kind of sawtooth down to make a bottom, that this little run right here may not be over. Maybe it's as simple as we go to that 1280 number again, and then we bounce back off of it and go back up to 1350. Maybe we repeat that again. That I'm not sure of. But, no real fear, or however much fear there is, doesn't correspond with how much excitement and hope there was when the market was pushing 1350. I think the high for this last move was on Monday, and I think it was 1359. And so it's kind of a mismatch of emotion, and so I think it needs to go down more. And we'll see if that turns out to be the case. You've got still a lot of guys coming on, and it sounds like there's one guy, his name might be Keating. He's on CNBC occasionally talking about the dividends, and I actually don't know what he's saying. If he is saying that he thinks a bottom is in, or if just a bottom for the news is in. If you listen closely, you still can't tell exactly what he's saying. I saw him on Bloomberg in the middle of the week, and then he was on CNBC on Friday. And so I'm not sure. But either way, point being that there is, the notion that this is over, just it doesn't make intuitive sense. This has been, regardless of the lack of ability to quantify it, it's clearly a big event. And big events just don't resolve themselves with 17%, 18% declines. We spiked down a couple of times near 20%, but that was such a short time period that I don't think of that as really being it. Okay, and if it is, let's say I'm wrong, and if 20% does count somehow, that brief drop into that level, even so, that is just not a normal bear market, and the event that is unfolding, whatever it really is bigger than normal. I've never said that it's not bigger than normal. I just don't think it's the end of the world, and I don't think the result is going to be that the market reaction is worse than normal, which is a normal bear market decline of about 30%. I've said that a bazillion times, and we're just, I don't think we're that close. And both time-wise and percent-wise. We've had a lot of damage, and at 20%, if you can buy into that 2/3, 1/3 rule, then another 10% makes sense, and another, we're, I guess, 6 months in, so another 12 months makes sense. And it won't be so bad. A lot of people, I think, will forget. Come 2012 or 2013, there might be a lot of people that forget if we just end up having a 30% decline. But I think it's really early to make a big bet. If you want to wait to really feel good about something, one thing you could do is wait for some sort of crossover of moving averages. Pick a couple of different moving averages that you think are relevant. That's one sign of health for demand. That's something that's come up over and over. Anytime I talk about my use of the 200-day, someone invariably throws in something about a crossover. Certainly just as good, maybe better, not sure, but either way, it communicates something about the health of demand. In a similar fashion, whether it's better or not, I don't think either one can always be better. I think one can be simpler, but either way, I don't think one can always be better. But be that as it may, so for now, I'm still light on financials, light on discretionary. I am heavy on telecom. Actually, that's one that has not gone well. When I say heavy, the benchmark is in the threes. It changes often enough. I didn't look the day I'm making this video. The index weight is in the threes, and I'm at about 4%. So I'm overweight, but it's not dramatic. But targeting 4%. So mathematically, that is a drag, but it's not a big drag. Utilities have taken a hit. Similar thing. The index weight is in the mid threes somewhere. I target 4%. And it's, older clients probably have a little bit more than 4% from the standpoint of utilities did so well, but they never grew to like double their weight in the portfolio or anything like that. Technology I've been underweight on. I guess I'm underweight in most things because I have a lot of cash, relatively speaking, built up in the portfolio. Also still have the position in the double short. One last thing I'll talk about is there was a debate at the conference about sticking with the double short, how it's not a great idea to stick with it. And I guess I would disagree because it does mute volatility. It's not a to the penny effect that I'm capturing. I don't really even concern myself with that, but it does on days where the market really pukes down or in stretches of time where it really pukes down. That does move a fair bit, and it does have a pretty good effect on the portfolio. So I'm quite pleased with how that is going. And I guess I'm starting to run out of time, so I'll just wrap it up by saying that I can't imagine that despite whatever feel-good rally is coming next, and there will be another one, I just can't imagine that we're done. We'll see if that holds water. Have a good weekend.